Imagine a continent brimming with resources, talent, and potential, yet shackled by historical burdens and modern challenges. Africa's economic story is far more complex than simple narratives of poverty or growth would suggest. Did you know that Africa's trade costs are 50% higher than the global average? This single statistic hints at the intricate web of factors holding back the continent's true economic power. Let's embark on a journey through time, data, and real-world examples to understand the forces shaping Africa's economic landscape. We begin our journey in the mid-19th century, a period marked by increasing European colonial influence. Our dataset, covering 1860 to 2014 across 13 African nations, reveals a pattern of banking crises, debt accumulation, and systemic shocks. These weren't isolated incidents, they were the echoes of exploitative economic policies designed to extract resources and benefit colonial powers. Fast forward to the post-independence era. While many African nations gained political freedom, the economic dependence persisted. Commodity reliance became a defining feature, with countries like South Africa heavily dependent on mineral exports. In the first half of 2023, nearly 60% of South Africa's exports came from its mining sector, a stark reminder of its historical role as a resource provider. This dependence creates a boom and bust cycle, as vividly illustrated by Zimbabwe's hyperinflation crisis in the late 2000s, a consequence of earlier economic mismanagement and structural vulnerabilities. Zambia's debt defaults in the 1980s tell a similar story of commodity price volatility and unsustainable borrowing. External debt service in sub-Saharan Africa has doubled over the past decade, reaching 2% of GDP in 2024. This growing debt burden diverts crucial resources away from vital investments in education, healthcare, and infrastructure. While some African nations are projected to be among the world's fastest-growing economies in 2025, these figures can be misleading. Take South Sudan, for example. Projected to be the second fastest-growing economy globally, its 3.9 billion GDP means that even a relatively small gain of 800 million can translate to a 20% growth rate. These so-called kindergarten economies are highly vulnerable to external shocks and lack the diversified economic base needed for sustained growth. A significant obstacle to Africa's economic progress is the dominance of the informal sector. A staggering 73% of employment in sub-Saharan Africa is in on-account of family-run microenterprises. While these businesses provide livelihoods for millions, they lack the scale and resources to drive productivity and create formal jobs. To truly unlock Africa's economic potential, the shift towards larger, more formal enterprises is essential. But historical data clearly demonstrates that strong governance is crucial for consistent growth. Countries with effective institutions are better equipped to manage economic shocks and sustain productivity gains. A prime example is Mauritius. Despite its small size, Mauritius has consistently outperformed its peers due to its stable political environment and sound economic policies. Then there is the challenge of energy insecurity. Less than half of Africans have access to reliable electricity. Closing this energy gap requires an estimated 190 billion annually, roughly 6% of the continent's GDP. Without reliable power, businesses struggle to operate efficiently, and households remain trapped in poverty. Adding to these woes are the increasing impacts of climate change. In 2022 alone, climate hazards affected over 110 million Africans, causing 8.5 billion in damages, primarily in the agricultural sector. Droughts, floods, and extreme weather events are disrupting livelihoods, exacerbating food insecurity, and undermining economic stability. Despite these challenges, there is reason for optimism. The African Continental Free Trade Area, or AfCFTA, holds immense promise. By creating a single market for goods and services, AfCFTA has the potential to unlock 3.4 trillion in economic activity and boost intra-African trade. However, realizing this potential requires significant investments in infrastructure, particularly in transportation and technology. Africa's current infrastructure gaps raise trade costs by 50% above the global average. Bridging this gap is essential for unlocking the continent's full trading potential. Optimism surrounding the continent must be tempered by the realities of the informal sector, energy gaps, climate damages that total billions annually, and even elite capture. The historical crisis data, spanning from 1860 to 2014, often underplays the extent of colonial extraction, focusing more on post-independence issues while the true systemic problems stem from the Berlin Conference. The doubling of debt service to 2% of GDP hides the role of vulture funds and the impact of IMF and World Bank austerity measures, especially since the 1980s. The path forward requires a multi-pronged approach. Diversification away from commodity dependence, investments in high-value industries, and the strengthening of governance structures are all essential ingredients for sustainable economic growth. Africa's economic story is still being written. By understanding the historical forces, current challenges, and emerging opportunities, we can work towards a future where the continent's vast potential is fully realized.